I don't care what you call it, just send me my dividend. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. This episode is going to be all about dividends, practicing the infinite banking concept as conceived and described in R. Nelson Nash's book, Becoming Your Own Banker, and dividends. Let me ask you this. Where else are you receiving dividends that grow an appreciating asset for you into the future, but that you can also access the capital of that dividend today? Let me preface by saying that dividends are not guaranteed. It's necessary to know that. All my clients know that. If you're vetting this idea if you're considering practicing the infinite banking concept, know that dividends are not guaranteed. The illustrations will tell you that. The contracts, the illustration should tell you that if you're looking at a full illustration. The contract will tell you that. And why dividends come into consideration even as a topic for us to cover would be because I promote the idea that you should become your own banker, at least that you can. And the way to do that best is by purchasing whole life policies that have been properly structured for the banking purpose with a mutual company, that way you're part owner of the company, that pays a dividend. Now, while I recognize that the dividend is not contractually guaranteed, I also recognize that the track record of various companies show that a consecutive dividend has been paid year over year consecutively for well over 100 years. Now just think about that. Consider the history that has taken place over the past 100 plus years. I own policies with a company that has paid consecutive dividends for over 140 years. Now again, in looking at history, we're talking about global wars, pandemics, recessions, depressions, conflicts, etc., government shutdowns, fill in the blank. And on weekends and holidays, year over year, when you own a policy, your cash value grows day over day. And a dividend is a reflection of the general performance of the company. So that would be on top of any guaranteed interest rate on a policy in the contract of your policy. Any guaranteed interest rate that there is going to not include the dividend. So the dividend is not guaranteed. But again, if we are students of history and can read and will look at what has been accomplished by the kinds of companies that I'm talking about. And I'm not married to any one particular company. My wife and I own multiple policies with multiple companies. But a dividend paying whole life mutual company is what we use and it's what we promote. So I'm not married to any one of them. I'm married to my wife, and yet these companies have provided a dividend consecutively for year after year. And again, let me reemphasize that a dividend is simply a representation of the general performance of a company's experience. What kind of yield is above and beyond what it takes for them to meet their contractual obligations of paying death benefits and, of course, paying for their personnel at the home office and all these different things that runs the company for the mutual owners of that company, such as myself or you. And above and beyond that, based on the general performance of the company, you may see and can reasonably expect, have a high expectation of a dividend. And there are many different things that you can do with that dividend, and we'll talk about that. But let me continue to say a little bit more about how so much is said in the vast world of financial entertainment about whole life insurance, dividends, etc. So I want to be able to address some things that you may have heard of or will hear about. Dividends are not guaranteed. Also, dividends technically, and according to the IRS, are a return of premium. Now, some will try and say that a whole life insurance is overcharging you and they're simply giving you your money back. And I understand that perspective, but if we can look beyond that very pointed opinion to realize the benefit of being both a consumer and a owner, being consumer and an owner of the same entity is a beautiful thing. Simply put, to reference Nash's work, if you owned a grocery store, where would you do your grocery store shopping? Surely you wouldn't go to your competitor to buy groceries from a different grocery store than your own that you own. Likewise, if you as a consumer find yourself attracted to a particular grocery store and you have the opportunity to become part owner of a grocery store, wouldn't you prefer to be part owner of the one that you enjoy as a consumer? I'm just using some simple deduction here to recognize that, yes, these companies that have properly done business, well established for well over 100 years, do realize gains and profits and dividends from what they do because of their long-term, their long-range planning. They're doing what many other individuals are not doing. They're thinking 30 years into the future, 70 years into the future, and so on. They are producing these dividends, and then again, in a mutual company, policy owners or part owners of that company will receive, respectively, dividends. So, yes, according to the IRS and technically, a dividend is a return of premium, meaning that more money overall was collected by the insurance company than was necessary to simply pay the death benefits when necessary, pay the personnel at the home office, and all the things to run that business, to run that company. And we have a return of premium. You know, my sentiment is very, very exactly that of Mr. James Nethery when he says, I don't care what you call it, just send me a dividend. And that's exactly how I feel. And I believe it's necessary for us to recognize that insurance has been around for hundreds of years, whereas the Internal Revenue System has only been around since 1913. So life insurance predates the IRS and the 1913 tax code that began then and to now. So that is why dividends are classified as a return of premium, because that is what they are. That is what keeps these companies so conservative, so safe, so long-lived, to have been successfully running as businesses for as long as they have and be paying dividends and be giving a return of premium. And any more conversation about the subject of, well, they're just giving you your money back. What kind of a company would you want to be a participant or a consumer of? One that is going to be there tomorrow, or one that may not? One that we have a much more conservative and long-lived approach, or an instant gratification approach that can run us into the dirt? So at this point, what I'm saying is that a dividend is a return of premium. A dividend, because it is from an insurance company, is a return of premium. It is not taxable. So when you do receive a dividend, that is non-taxable. It doesn't have to be reported. And then from there, you do have several options of what you could do with that premium. You could simply get a check in the mail. You could just simply take the money. You could also use that dividend every year to reduce the premiums that you're paying if you want to do that. Nash actually talks about how he did that for the first 15 years, I believe it was, on a policy. He reduced the premiums on his policy by using the dividend to offset that cost. And then he also talks about why he regretted that. So when we understand the dividend and the power of it, we will probably arrive at the conclusion that Nash did, that when we use a dividend to buy, because we have this as an optional, it's a contractual option, and you could change option from year to year. You could reduce premiums one year if that's what you choose to do. And isn't that beautiful? Isn't it beautiful that as the owner, you are the one getting to decide what happens to this dividend? Take it in cash, reduce the premiums, etc. But what Nash arrived at, and what I've personally practiced over the past 6 years or whatever it is when we get a dividend, and I'll talk a little bit about ours this year. When we get a dividend, we have the option to be able to use those dollars today to buy paid up additional insurance. Now, this does a few different things for us, and it's worth noting here. So we can use the dividend today to buy paid up additional insurance. Now, what that does is it grows our death benefit. So again, if you started out with a policy of X amount of death benefit and you use your dividend to buy more, well, that number has grown. And obviously it can continue to grow exponentially, compounding year over year. What that also means is that because the death benefit is growing in a properly structured policy that pays a dividend with a whole life insurance company, you should have contractual rights to access the capital in your policy. And if the death benefit is growing, that inherently means that the cash value of your policy is growing. Again, day after day, on weekends and holidays, the cash value of your policy will also grow. So much like the death benefit can grow exponentially or compoundingly, the cash value of your policy can exponentially be compounding. So the cash value of your policy is just a net representation today of the net value of that future death benefit. So if that death benefit is growing because you're applying a dividend year over year to increase that number, the cash value is growing year over year as well, which means that you have access to more of your capital. And when you get a dividend and you apply it to buying paid up additional insurance, which also increases the cash value of your policy, while I've also mentioned that the that the dividend is not guaranteed, when you do receive a dividend, that value cannot go down. It is not at risk of decreasing. Contractually, you will be able to apply that dividend to increase your death benefit by buying paid up additional insurance at no acquisition cost. This is another point. There's just so many points here. It's really fascinating how consummate of a vehicle a dividend paying whole life policy is for practicing privatized banking. So at no acquisition cost, and my business folks may understand that more readily than my non-business folks, but look into that a little bit, and as I explain it, hopefully there'll be more light shed on that. That acquisition costs you nothing. The dividend was going to be earned, and when it is, it costs you nothing to buy that additional insurance. So there's so many points there. Again, if you were limited at the time, and we all are limited in how much insurance we can get on our person, on our body. But when you recognize that a dividend year over year can be applied to the death benefit, to the legacy that you could be leaving behind to those that you love at no acquisition cost, you're also increasing a tax-free transfer of wealth that in the future is not guaranteed to grow by acquiring other policies. I don't know what my health may be next year, in the next 5 years, or next month, or what have you, and neither do you. No one does. So what a beautiful concept that we can still be growing even with what we have right now. At least if you're already a client, if you already have a policy, that can grow. If you're vetting the idea, I cannot say that time is not of the essence. It is. Time is of the essence. That's not a pressure move. I'm just simply saying vet this idea appropriately. Read a $20-something book, with only 92 pages, large print, big illustrations over the next couple of hours. And I believe that you can find out enough to realize that you want to become your own banker. And then it's just details from there. It really is. Again, to reference James Nethery, he says, when you recognize what's going on, the details don't matter. And if you don't recognize what's going on, the details don't matter. So it's all details from there when you realize I want to become my own banker. So study, learn, know, ask questions, have a conversation. Let's have a webinar. Understand what it is. I'm not promoting that I be your banker. I don't want you to be my banker. I'm promoting the idea that I can be my own banker. You can be your own banker. So we can acquire at no cost of acquisition a growing death benefit and inherently, therefore, a growing cash value that we can access today. So while that dividend is growing our death benefit, it's also today growing the cash value that we can access. We can access more and more capital year over year while still continuing to grow that future death benefit as well. And in so doing, recognizing that nothing is promised for tomorrow, if there is a change in health, it doesn't mean that we're limited to what that policy looked like at the moment of its enforcement. So if for whatever reason I'm uninsurable or you are uninsurable in the future, for whatever the reason may be, to get another policy or a policy, then it doesn't mean that we're limited just to what a policy that we already own looks like today, because it can grow and develop, which is an amazing concept. So the dividends contribute to a perpetually growing asset. And that uninterrupted compounding can contribute greatly to an eventual passive income. So when we reach a set time in our minds or in our trajectory, in our plans of we're wanting to receive a passive income from our policy or our system, as it should be a system eventually, we should have a system of policies that we can use to account for our need of finance and as our warehouse of wealth, the place that we put our capital. Our privatized banking system should eventually be able to accommodate us with a passive income. And again, a dividend plays a great role there. And that's why Nelson lamented his first 15 years with his State Farm policy of reducing the premiums and not instead applying his dividend to buying more paid up additional insurance, because it would have been even better than he had described at that time. And it was pretty impressive at the time. Now, I will say that what brought this particular topic to mind for me is that recently I looked at some statements from various policies that my wife and I own. And not to be too specific, but just to plant the seed of some ideas, we had one policy that is in its 6th year. We had another policy that is in its 5th year. And respectively, and at the time of this recording, we're at the end of September 2021. So this is during what is being called a pandemic year, 2020. We had in that 6-year-old policy a dividend that bought 4 times the amount of death benefit. So we could have just received that dividend as a check in the mail. We could have also have reduced our premiums for that year. But instead, what we chose to do was buy paid up additional insurance. So we were able to buy 4 times the amount of death benefit from the dollars that we would have received today. So again, to simply put it, we just 4x'd, over then 4 times our capital into the future. Now that is the epitome of an appreciating asset. An asset being something that puts money in your pocket. See, that's a greater and a greater amount of capital that we can and do access for our need of finance. We do diligently pay as significant premiums, and we do access our capital for our need of finance in our household and in our business. And I'm sure I'll be giving more examples soon about how we use our policy funds to be able to do the things that we do as a family and to do the things that we do as a business. But 4 times. We had another that we received or would receive a cash dividend, and it procured for us over 5 times that amount in a death benefit. So again, let me reemphasize, I'm not married to any one company. We own multiple policies with multiple companies, and we continue to expand our system. We have policies in underwriting right now to expand to our system. But when we realize that we can have dollars today that buy exponentially a compounding number in the future, and that we can have a respectable anticipation to be able to do that year over year after year to increase what is going to be a part of our legacy, a part of a tax-free transfer of wealth to our future generations, our children, those that we love, and that we have the contractual right to be able to use our dollars to do that, to be able to procure that at no acquisition cost, have it be non-taxable. Again, let me say that, non-taxable, and improve and grow and scale this already appreciating asset. It's just a beautiful thing. So I hope that this has been helpful to discuss dividends and practicing infinite banking. If you'd like to carry on this conversation, to be able to vet this idea or find out more about becoming a client, to have a webinar, whatever would be helpful to you along your path, you can reach me at 828-817-4223, or you can email durhamtalents@gmail.com. I look forward to our next conversation. Have a great day. Take care. To dividend or not to dividend? That is the question. Yes. Hello. It's real life right there, people.